Hello and welcome back to our trader training video series. On this short presentation, we're going to look at some more details of the options and what they are. We've already established that the options that we have available are part of a chain, and we've already established that we want to select an option with an expiry or a duration, more specifically, of 25 to 45 days. And that means that at the time of this recording, the March 2016 date with 42 days to expiration is the option that we're going to focus our attention on for most of what we do. There's a few exceptions and we'll cover that on the individual strategies, but for now, if we want to know which option that we're choosing, this is the one that we're going to do. The one that falls within that 25 to 45 day range. Down the center, we have strike prices. The strike price represents a dollar amount of the stock. Now, if we just go here, the stock price is currently $121.11. So what we can see is that there's almost a division, and we can see that it does change color at the current price of the stock. So now we have two sides. Again, if we just focus our attention on the call side for the moment, the call, just to remind us, is if we're wanting the right but not the obligation to buy shares at expiration, we would be thinking of a favorable movement in the stock price that would increase in value. So there's two sides to this now. We've got all the options below the current stock price. Again, the current stock price is $121. Let's just pop that here, 121.11. So all the options below $121, and we can see here 120, 115, 110, all the way down to $90. These are the ones that we can see in view at the moment. All of those options can be deemed as being in the money because we've got 42 days of time. We've got the duration that this option has to expiration, plus the value of the stock. So if we were looking at $120, this strike price, if we were to agree to purchase stock at $120, that's what we're saying. At expiration, we would get stock at $120. We would own them at $120. But we've also got the additional value right now of $1.11. So it's got the duration, the time, and the additional stock value. If we went down to $110, just as a very quick illustration, we would have, at expiration, if we were to buy that call, we would have the right to own stock at $110. So this particular option has, again at the moment, the 42 days worth of time plus the stock's value. And the difference between $110 and the current value is $11.11. So we would own the stock at $110 and we would be $11.11 profitable from where we own the stock to where the current stock price is, assuming that, of course, that the stock price didn't change in the next 42 days. So all these options are in the money. They've got the value of the option, which is made up with a variety of different component parts, but just to keep it simple, we'll just say that it's got 42 days worth of time. And the in the money option has the stock's value added into it as well. So it's got intrinsic and extrinsic value. All the options above the current stock price on the call side, so $125 all the way down to $155 or all the way up to $155, all have just the time value. So it's got just this value of time. And again, there's a few other factors which contribute to the pricing. So it's just time that we're purchasing. So all those options would be said to be out the money because they've not got the stock's value factored into the option. So we've got in the money options and out the money options. The individual strategies that we use, which we'll look at later on, will help us determine which strike prices and what we're doing and why we're doing it. They'll be explained on the individual strategy videos, but just to explain the components of the options and the contracts and what all the moving parts actually are, this is what this video is about. So we'll look at strategy specific requirements and which strike price we would select depending on the strategy that we're using on a later video. So in the money, out the money. In the money includes the stock's value. Out of the money just has the, again for want of a better description, just the time value plus a few other factors which contribute to the pricing. The strike price is the price at which we're agreeing to take delivery of the option that we've got. So a quick reminder then, if I'm buying a call option with a strike price at $120 and at expiration, let's just say that 42 days has passed and the current stock price is $121.11, I agree to buy $120 or share stock at $120, then I get to own, I have the choice, not the obligation, the right but not the obligation to own stock at $120 each, and the current stock price would be $121.11. I would have a profit of $1.11 per share. That's essentially what's happening. That's what we're agreeing to do. And again, we're just digging a little bit deeper into some of the more interesting details of what the option is and what those details actually mean. So on the next video, what we're going to look at is, again, just to dig a little bit deeper on the options and just to try and understand how this relates to the chart, which we've looked at on previous videos, and how we can start to look at which options make the most sense for us to start either buying or selling. And with that said, I will see you on the next video.